and welcome to the program. I am BC Adebayo. Coming up today, World Bank approves Nigeria's $1.5 billion loan. Nigeria's headline inflation rises to 14.89% in November. Plus, Moody's says Egypt's diversified economy supports B2 credit rating. But first, let's kick off with the market. Now, investor sentiments in Africa were mixed at intraday. Nigeria's main index sustained yesterday's positive sentiments, rising about 0.5%, while South Africa's GSC declined 0.5%. Elsewhere, the EGX 30 advanced 0.4%, while Kenya closed positive on Monday. And it's a different picture in the Middle East, where investor sentiments were mostly negative. The market in Saudi Arabia was the only gainer intraday by 0.13%, while the Qatari index lost marginally by 0.01%. In the UAE, Dubai's main index shaved off 0.97%, while the Abu Dhabi index lost 0.41%. And in Europe, stocks were mixed in the morning as post-Brexit trade deal negotiations and the latest coronavirus developments continue to dominate market attention. Let's talk to Chelsea Delany to see how this is shaping the markets this afternoon. Good afternoon, Chelsea. New coronavirus restrictions are being introduced across Europe, including Germany, where you are, which is just a day away from entering a second hard lockdown. How are markets reacting to the new restrictions?
Well, surprisingly, we've seen markets actually gaining in recent days. As you can see behind me, the DAX is up about 0.7% today. And this has been really reflected across other European stocks as well. And that's despite, as you said, Germany about a day away from a second lockdown that will close schools and shops throughout the country, except for non-essential stores like grocery stores. This will be an economic blow, but for now, investors seem to be brushing it off yet again. We've also seen a number of other countries today and over the past 24 hours announcing lockdowns, the UK, the Netherlands, Denmark. So really a big wave of countries now looking at stricter lockdowns. One piece of good news that has supported markets is that we just got news that the EU does plan to approve a coronavirus vaccine potentially before Christmas. We had been looking at a later date for approval, possibly just a few days before the end of the year. So this does give hope that we will start to see Europe joining the UK and the US and other countries and rolling out these coronavirus vaccines before the end of the year.
Now let's talk about the EU Commission, which will today present a new Digital Markets Act that will increase its powers to regulate big tech. What kind of new rules could we see?
There will be some pretty severe changes for these big tech giants. They are looking at, for one, changing the way that these companies are able to operate. That's really the thrust of these rules, is that they don't just want to penalize the companies. They want to actually change the way that they behave and the way they operate, so they can sort of cut these anti-competitive behaviors off before these companies grow too large. So companies like Apple, Amazon, Google would no longer be able to, for example, use the data they collect on other companies through their platforms to inform their business decisions. A company like Amazon wouldn't be able to promote its own products over the benefit of its competitors on its website. So they want to take away the competitive advantage that these companies have, and there would be really severe penalties if they don't comply. So if they don't comply with the competition rules, they could face a fine of 10% of their global revenues. That could be tens of billions of euros for some of these companies. And the last resort, the nuclear option for the EU under these new proposals would be their ability to break some of these companies up. So they are really strict penalties. We will have to see how it plays out. Today's decision or announcement will just be a proposal. It will likely take years before this actually comes into law.
All right, Chelsea, let's talk about the effects of the coronavirus once again. Now, Germany's Volkswagen has been forced to shut down its plans due to an outbreak of the virus. Tell us more about this story.
So this appears to be an outbreak at one of Volkswagen's suppliers. So it appears that several employees at this supplier that makes foam parts that go into Volkswagen vehicles contracted the coronavirus, and as a result, that supplier had to be shut down, which has rippled through to really Volkswagen's operations across Germany. Volkswagen is said to have had to put several thousand employees on part-time work right now as a result of the fact that they aren't getting the products they need from that supplier to continue work. This is a bit of a new development for the German industrial sector. The German industrial sector has been doing very well over the past couple of months. We've seen production really holding up despite coronavirus restrictions and that have really hit other industries. So I think what this really shows is that there is a risk to the German industrial sector as well, that there could be more infections there. That would really be a big blow to the German economy as well if we start to see manufacturing taking a hit.
Thank you, Chelsea. To enjoy the rest of your day. Right now, let's take a trip to London to see how the markets are reacting to the tougher new restrictions as well as the unemployment data that came in this morning. And Juliana Olayinka will be telling us how all of that are playing out. Juliana, it's you and I once again. We spoke earlier about the tougher restrictions coming into effect on Wednesday, but then there's a follow-up to that. The Cabinet Minister, Stephen Barclay, is asking people to act responsibly by keeping social contact to a minimum over Christmas. Are you getting any reactions to this yet?
Good afternoon, Bissy. Nice to see you once again. Well, look, it's not just Stephen Barclay. There are lots of really senior professionals that are now asking the government to once again do a U-turn on the ease of restrictions at Christmas. Just to remind our viewers, between the 23rd and the 27th of December, so for about 5 days, the four kingdoms will be relaxed. So across the United Kingdom, the government have allowed households, 3 different households, to mix together for Christmas. But now that has become a huge topic of concern as we are seeing COVID cases once again surge here in the UK. We spoke about the first wave and the second wave. Now, apparently, there's a third wave. Just about an hour ago, the most eminent doctors and medical professionals in Britain have written a joint editorial asking the government to urgently reconsider this. They said, a lot of tabloids are saying, people are going to be killing their grannies at Christmas. But they are suggesting that if the trajectory continues in the way it is, then 19,000 people will be in intensive care units before the end of the year. And that number is really significant because at the peak of the first wave in April, we had about that number. So that just shows how bad it is. And this is not taken into account, these 5 days of Christmas. We are expecting perhaps the government may U-turn. Again, this is another blow because, as you said, from midnight to night in London and parts of Greater London, including Essex, Hertfordshire, some parts of Surrey, they will transition into Tier 3, which means pubs, hotels, hospitality industry are going to shut. This is causing lots of concern. Some people are saying, this is the final nail in the coffin for them. In fact, many of our viewers who live in London would see that some pubs just haven't been able to reopen. They've spent hundreds of thousands trying to make it COVID secure. The government to to-in and throw-in complaints that the messaging is not really clear. But now, as the government have asked university students to go back home, have told people that they can see their loved ones on Christmas, the COVID rate, the rate of infection is just not making doctors and nurses feel comfortable. And they said if the government doesn't do a U-turn and stops this 5 days of Christmas relaxation, then we could be in a really serious case of trouble here in Britain.
So how are the markets reacting to all of this, talking about the new restrictions and the unemployment data that was released this morning?
Yeah, well, the FTSE is slightly subdued at intraday, still in the positive. But as you said, we spoke this morning about this unemployment data showing that since March, over 800,000 people have lost their jobs. Unemployment stands at 4.9% in the 3 months to October. That's risen by 0.1% from the 3 months in September. You know, if you're one of those 800,000, obviously it's not great for you, especially considering Christmas is just around the corner. But economists took this information pretty positively. There was some optimism there. They did expect it to be much higher at 5.1%. And a lot of observers are pinning this down to the furlough scheme. The furlough scheme, the job retention scheme, paying up to 80% of people's wages. That was supposed to come to an end in October. So a lot of business owners and companies were getting rid of staff they didn't think they could afford. But then, of course, at the last minute, as we've seen constantly with this government, Chancellor Rishi Sunak did a U-turn and has extended the scheme. So there are hopes that perhaps this could be the peak. However, Bank of England are saying we're expecting unemployment to rise to about 7% in Q2 of next year. And so there's a mixed bag of information, of course, as well. We still have that COVID vaccine inoculation still ongoing across certain parts of the UK. So the numbers at intraday, the FTSE All-Share is up 0.19%. The FTSE 100 is up by 0.17%. And the FTSE 250 up by 0.20%. In the currencies market, the British pound down on the US dollar by 0.70%, down on the euro by 0.21%, and down on the Japanese yen by 0.06% at intraday.
All right, Juliana, away from all of that now, do we have any update on Brexit?
Not much. Lots of to-ing and throwing. Most of the media and sources close to Brussels are just trying to doorstep whoever they can, really, to try and get some sort of comments. But, you know, if you look at the markets across Europe, there is still a sense of optimism, even here in London. So we know that negotiations are continuing. There isn't a deadline on these negotiations. However, of course, the 31st of December is just 16 days away. So that really is the hard deadline. Michel Barnier, the EU negotiator, and Sir David Frost, Lord Frost, the British negotiator, are going back and forth. Apparently, there appears to be some concessions made on the level playing field. I know fisheries has been one of the main topics of discussion, or one of the main reasons of discontent. But there have been some suggestions that, you know, if you look at both economies of Britain and the EU, fission isn't really that significant. So they're wondering why they have allowed it to hold the talks for this long. So perhaps some concessions will be made against that. And then, as I said yesterday, there are some whisperings that perhaps we would crash out at the end of this year with a no deal, but there would be a gentleman's handshake, that negotiations would continue perhaps into January, February, and then a new deal would be signed. But, you know, who knows? It's all to play for. So perhaps an update in the morning will reveal more information, Bissy.
Absolutely, Juliana. Thank you. Of course, I would definitely see you again tomorrow morning.
Thank you.
All right, now let's head to Asia, where stocks were lower today as concerns over coronavirus surge in multiple countries dulled optimism over the vaccine rollout in the U.S. Mainland Chinese markets were mixed. The Shanghai Composite dipped fractionally to 3,367.2, while the Shenzhen Component gained 0.52%, and Hong Kong's Hang Seng Index was about 0.6% lower as at its final hour of trading. In Japan, the Nikkei 225 dipped 0.17%, and the Topix Index was down 0.47%. South Korea's Kospi shed 0.19%, and shares in Australia were also down, with the S&P ASX 200 down 0.43%. U.S. stock futures were mildly higher in early morning trade as Congress continued negotiations on another economic relief package and vaccines began to roll out across the country. Futures contracts for the Dow Jones Industrial Average gained 103 points. Futures for the S&P 500 and Nasdaq 100 were also both in slightly positive territory. Lawmakers released the latest proposal for another round of economic relief on Monday evening, splitting a previous bipartisan proposal in two parts. Investors will be watching new data from the Empire State Manufacturing Survey to get a read on that segment of the economy. The Federal Reserve will also begin its two-day December meeting with a policy statement and a press conference for Chair Jerome Powell scheduled for Wednesday. Nigeria has finally gotten the approval of the World Bank Board to get the $1.5 billion loan requested by the federal government. According to a statement by the multilateral lender, the facility is a 5-year country partnership framework that will last from 2021 to 2024. The bank explains that the fund will help build a resilient recovery post-COVID-19. The framework will help Nigeria address issues on human capital, economic transformation, job creation, public sector financing, among others. And Nigeria's headline inflation has increased for the 15th consecutive month to 14.89% in November from 14.23% in October. The latest inflation data released by the National Bureau of Statistics also shows a spike in food inflation, which jumped to 18.3% in November from 17.38% the previous month, and core inflation declined to 11.05%. The Statistics Office attributes the rise in the food index to increases in the price of major food commodities, including tomatoes, potatoes, yam, and other tubers, as well as fruits and vegetables. Urban inflation was up to 15.47%, and rural inflation was seen at 14.33% also in the month of November. Now, this latest inflation figure is aligned with the financial derivatives forecast of 14.8%, where the analyst cited November as the first month in which the impacts of the increase in the price of PMS and a partial rise in electricity tariffs will feed into the inflation basket. And Moody's says Egypt's diversified economy has supported its B2 issuer credit rating. According to Moody's, relatively weak but improving governance indicators are balanced out by institutional and governance strength, along with Egypt's solid track record of commitment to implementing reforms. On the flip side, Egypt's public finances remain a weak spot, with a high government debt burden that is now in decline after rising temporarily due to the pandemic. Now, most fast-moving consumer goods companies have been sweltering under the shortage of dollars and forex rationing. Some are switching to local substitute, but in the meantime, both the top and the bottom lines of these companies are under pressure. Today on the Commodities Market Updates, we're looking at commodity-dependent companies and their performance on the Nigerian Stock Exchange. And Mayowa Ige, a research analyst with a financial derivatives company, joins us now to talk about that. Good afternoon, Mayowa. It's good to see you again. Now, cocoa, sugar, and palm oil are among non-industrial commodities used by FMCG companies in Nigeria. Can you explain how the volatility in commodity prices has impacted the financial performance of FMCGs?
Hello, VC. Thank you for having me. So generally, commodity prices, there's a strong correlation between commodity prices and the financial performance of FMCGs. If the prices of raw materials increase, then the margins of these companies will reduce, and vice versa. And because in Nigeria, for over the past 18 months, for instance, we have seen a very sharp and rapid movement in the prices of commodities due to the lockdowns and supply chain disruptions, border closures, forex rationing. And so that has affected the prices of commodities. And also, when we look at the shortage of dollars and the naira devaluation, that has added an extra layer of uncertainty as a result of the volatility in exchange rate prices. And that has affected FMCGs. And so all of these have led to an increase in the production cost and interest expense of these companies. And we know that the FMCG space is a high volume, low margin space, and it's highly competitive. And so all these, there's a limit, and with the decline in disposable income of Nigerians in this period, in these times, there's a limit to how much of these increased costs that these companies can transfer to the consumers. And so we have seen in Q2, Q3, we have seen the financial performance of FMCG companies. We've seen their sales increase, but then at the same time, we have seen a very significant decline in their profits before and after tax, with the exception of, let's say, flour mills that have already, prior to this period, they have already invested in backward integration, which has helped them a lot in this period.
Now, the Nigerian stock market has remained resilient in the midst of the global pandemic. Of course, we've seen gains of about 27% this year alone. How much of this performance has been driven by commodity-dependent companies like Nestle, Unilever, flour mills, for instance, and what is your outlook for these companies?
So, consumer stocks are generally considered to be a good buy on the Nigerian Stock Exchange because they are stable and they often give good returns. And so, we've seen companies in the FMCG space contribute significantly to this increased gain in returns on the Nigerian Stock Exchange. For instance, Nestle is one of the major drivers of this gain in returns. And then we also have flour mills. Investors often buy these companies. Investors have flocked to these companies because they have a positive outlook. Investors have considered them to have a positive outlook, and because of their resilient performance. And also we have because of the strategic plans and infrastructures that some of these companies have put in place before now that have help their financial performance over the period. And yes, with all of this, these companies have actually also been large contributors rather to the performance of the Nigerian Stock Exchange in this year.
All right, Mayowa, in the case of rapid recovery of economic activities, both globally and domestically in 2021, are we likely to see a corresponding increase in commodity prices, and what will possibly be the effect on the financial performance of the FMCG companies?
Okay, so with increased economic activities, we will see an increase in our national income, in personal income, and we'll also see an increase in purchasing power of consumers in Nigeria. And all of this would help to would absorb the price increase that we've already seen in the markets now. And with increased output from the FMCGs and other commodity-dependent companies, we would see a decline in inflation. And also with another harvest season coming, and also possible opening of the border closure, it will affect the current commodity prices. And with the newly approved World Bank loan, we expect that we will see the Naira gain in value, and this will also help the exchange rate at which these companies import raw materials. And so we will definitely see a slight reduction in production costs and increase in sales. And so we'll see an increase, we'll see better financial performance from these companies in the coming year.
All right, research analyst at the FDC, Mayowa Ige, thank you for your time this afternoon. And that's where we end today's program. Thank you for watching. I am BC Adebayo.